Welcome, everyone. We are once again sitting down with two of the sharpest minds on our investment team to get a breakdown of what's actually going on behind financial headlines. I'm Tara McBride, Chief Marketing Officer at Prime Capital Financial, and I'm joined today by my colleagues Clayton Allison, Portfolio Manager, and Will McGuff, Deputy Chief Investment Officer. These two spend their days navigating complex markets, analyzing global policy shifts, and making sure our clients stay ahead of the curve. If you're watching this, I'd like to share right from the jump that we have a free resource available for you to download at the link in our show notes. It's a great one-sheeter that will give you even more background on what market volatility means and how to plan for it. So make sure you grab that. Okay, we've been hearing about the potential for a Mag 7 correction. So today we're going to talk about what all of that means for your investments and how to navigate the storm if it hits. The Mag 7 includes Meta, Apple, Amazon, Alphabet, Microsoft, Nvidia, and Tesla, 7 tech titans that have fueled an unprecedented market rally, driving the indices to record highs. This has people asking, is the Mag 7 bubble about to burst? So, Clayton and Will, before we get into all of that chaos, let's level set. After back-to-back up years, what is typically in store for the markets in the year following?
Yeah, so I'll jump in with that, Tara. Thanks for having us on, and happy to answer all these questions for you. So you're right, 2023 and 2024 were two big years in the S&P, 25% plus in each. So 3 in a row is pretty tough for the markets. And what typically happens after 2 back-to-back up years, and especially with the previous year before that being down, like 2022, stocks and bonds were down, we kind of see a ho-hum year where average S&P returns are in the single-digit range. Now, when we look further into the data, it actually corresponds to the first year of a presidential cycle more often than not as well. And we all know Washington, D.C.'s having a lot of policies reverb through the stock markets, which is creating a little bit of back and forth. So that's where we're at right now with regards to, we've had 2 great years, probably a ho-hum this year, and obviously the Mag 7's front and center. Clayton, as running our stock portfolio, is anything you see more from the bottom up side?
Yeah, I mean, I think you're completely right there. Like you've seen historically, usually it's, like Will said, mid to low single digits on returns for the index on the following year, following these kind of massive 2 up years. And I think that's probably historically healthy because you can't expect your returns to be, 20+% in perpetuity forever and ever. So a little bit of a pullback is healthy every now and then. Now, what we've kind of seen from just a more sector weighting exposure, kind of fund flows, is the fact that from the start of this year, you're seeing a lot more people transition their funds from these kind of tech titans, like you've mentioned, Tara, the Mag 7 and everything like that, consumer discretionary, into more defensive, value-oriented, or just broad market exposures to kind of reduce that risk a little bit. Like we've seen kind of historically massive fund flows going from tech to these other areas just over the last couple of weeks. Now, that's just kind of further exacerbated from what Will was saying. You have a lot more policy going on in Washington that's leading to a lot of choppiness in the markets. People get a little skittish, so they look for safe havens and more defensive-oriented sectors where they, while the rewards may not be as high traditionally in your, like, let's say, grocery stores or consumer staples, it's a safe place to kind of put your money in times of volatility.
That's great. So what has changed in 2025 with regards to how the Mag 7, i.e. market concentration, is driving price action as compared to last year?
Well, I mean, I can give a start, and then Will, he's the smarter one of us two anyway, so he can probably bolster it a little bit. So what's changed a little bit last year is obviously AI has been the prevailing theme over the last 2 years. Now, in addition to that, we've seen moderating inflation. So as inflation comes down, there's the prospect of lower rates. Now, this year, what's kind of changed is we've seen inflation be a little bit stickier. You have a new administration in the White House that is talking more tariff-oriented policies. So the entire trade dynamic of not just the U.S., but globally is starting to shift. To combat that, you've got to keep rates higher. So then companies can't borrow at lower rates, not exactly propelling growth that higher forward. Now, these Mag 7 companies do have some of the strongest balance sheets known to man on any company in the planet, but to piggyback off of that, they are starting to get questioned whether or not that their investments in their AI products are really going to be generating the returns that all investors have been promised over these last 2 years. You see companies like Meta, Amazon, pretty much the entire 7. Maybe not Tesla as much. They haven't had as much CapEx guidance as the others, stating that they're going to be spending upwards of $65 billion in a single year just to build out their AI infrastructure. Well, that's a lot of money, regardless of if you're a $1 trillion company or if you're a $3 trillion company. That's still a lot of money. So if I'm an investor, I want to make sure I'm seeing an actual return on this CapEx figure. And a lot of these companies continue to push them farther out into the future of, hey, it's going to come, we're going to make all this money based off of these investments. And that seems like now with these prevailing, headwinds from the administration, from economic data, investors are getting a little less patient as to how long they're willing to wait to see that return.
Yeah, so you just heard Clayton gave you all the reasons from a bottom-up standpoint. If I want to zoom way out and look at this super simplistically for our advisors and investors, in 2024, NVIDIA was the second best stock in the S&P 500. In 2025, NVIDIA is middle of the pack, so call it 250 out of 500. That's a big difference for one of the largest stocks in the world and it just shows the concentration drove the market in 2024, and then underneath the hood, it's middle of the pack. If we look at Tesla, for example, it was a top 30 stock return-wise last year, and it's a bottom 30 stock this year. So in my opinion, the fact that the markets are kind of holding steady this year, flat to a little bit down, is an anomaly in and of itself, with most of the Mag 7 down double digits. So it's something that we're going to have to watch. And we're here talking about Mag 7 correction, and the typical term for a correction is down 10 to 20%, with the bull market being down more than 20%. Most of these Mag 7 stocks are in a correction.
Yeah, there's so much to watch, right? Like I think you pointed out, Will, that the information from day to day can get stale, but just kind of like understanding the larger picture is really important. So there's been a lot of talk about U.S. equity markets being, quote, overvalued. What does that mean to you, and how are you thinking about valuation today?
Yeah, so we're big fans of the JP Morgan Guide to the Markets. They do a great recap, and it's on a daily basis now. You can get updated information. So if we look at the S&P 500 at a very high level, which again is all 500 stocks, the price to earnings ratio is about 22 times. What does that mean? It means that the price that you're paying is 22 times higher than the earnings that you're getting from buying the stock at that price. There's 2 levers which market participants can drive valuations. It's the price to earnings ratio, but then also how much are the earnings growing, so earnings growth. If we look at a year like 2023, earnings didn't grow, but price to earnings ratio expanded, so stocks went up. A year like 2024, price to earnings stayed kind of the same, but earnings grew, so stocks went up. So we're at a point now where we're kind of peak PE and peak earnings growth, which is giving investors pause for the Mag 7. We're meeting earnings looking backwards, but guidance has been a little bit weaker. And so with that, we have to be cognizant of the price that you're paying for stocks, and we're at highs similar to .com, similar to post-COVID crash. So things are getting a little stretched. Clayton, from a stock standpoint, bottoms up, like, can they get more stretched, or are we going to see PE ratios come in?
I think to your point, Will, it's all dependent on that guidance that they've gone out forward and issued. Now, a lot of the companies, once again, these Mag 7s, their performance quarter to quarter is historically great. They've still been good these past couple of quarters. They've come out either beat or met expectations, and that means growing revenues and profits by like 20% year over year. Any company that's that large of a market cap to be able to grow revenues at that rate is still amazing. Like, I think people at times do take that for granted. However, to your point, their guidance has not been nearly as strong as some of the market really wants it to be. They expect to beat and raise every single time and then lead to this euphoric kind of growth time over time again. That's kind of why NVIDIA has now gotten kind of hammered this past week or so, because they've been the one leading the charge on, hey, we grew by 100%, and we're going to do it again, and we're going to do it again, and we're going to do it again. So, like you said, those PE multiples have continued to widen out and continue to grow because they're baking in, well, NVIDIA is telling us they're going to keep growing, so it's baking in those growth estimates looking forward into the future. But if the estimates going forward are not as strong and we're not seeing tangible earnings growth as a result, that can only lead to multiple compression. I'm sure a lot of people that are watching this have heard that term thrown around: earning compression, margin compression, ratios. Essentially, that's just meaning that those multiples have to come down and meet where the actual hard figures are sitting at. Now, a lot of what these Mag 7 companies have been guiding to going forward into the future, the prevailing theme is, hey, we're growing really well. Our estimates aren't as high as you're expecting for this upcoming year because we are capacity constrained. And what that means is everybody wants their products. They want their AI demand, they want their products, their services. They do not have the capacity to meet the demand. So I think some people do kind of miss out on that portion of the data, that these companies are growing. They expect to continue growing, but they've got to spend money to make money, so to speak. Now, I do agree with Will. We're kind of at peak valuations, especially from tech right now. We're a little bit overexposed on that from a market standpoint. Tech as a whole has really baked in this growth going forward, and that has really led to this, margin expansion and the ratio multiple. But at some point, investors want to see tangible results. And if they don't, that multiple will come down, compress. And I think we're starting to see that a little bit right now.
So speaking of investors, I have a couple of what I would call like investor perspective questions. So given the potential for a correction, do you see any of the Mag 7 as long-term buying opportunities post-correction if that occurs?
I think it's hard to really turn any of them away long term, because in the end, we always speak to being a long term investor. Now, a lot of these companies have the sheer scale and size to continue to be market leaders and market innovators. Like I just said, you have to spend money to make money, and these are some of the companies with the strongest balance sheets on the planet, with proven track records of innovation, to where they can utilize their free cash flow and put it to best used products and development and really lead the R&D charge. Now, where they kind of could be exposed is the fact that the first mover advantage doesn't last for forever. I think Apple's a perfect example of this. They were not the first person to come out with the smartphone. They just kind of perfected it when the iPhone came out. They weren't the first one. So while NVIDIA may be the first AI chip and everything of that nature, all it takes is the next up-and-coming company to really perfect that and kind of lead to new market leadership. But in the end, like a lot of these companies, really strong competitive moats, pretty much fortress-like balance sheets. So long-term investors, yeah, you kind of want to ride with the market, not take your chips elsewhere, so to speak.
Yeah, I would totally agree. And this is where the financial advisor comes into play with regards to the unique circumstance, risk tolerance, and time horizon of our investors. Those with shorter time horizons should be very cognizant of just equity exposure in general. Rates are 4 to 5%, not taking much risk there. Long-term investors, you need exposure to these trends. It's the Mag 7 right now. I don't know if y'all remember, it was the FANG a few years prior with Netflix involved. It could be the Mag 10, the Mag 12 in the future. That's our job as investment professionals, is to help our advisors have the tools they need to get the right exposure. But again, it's we're just taking a step back and looking at where we've been. Big run up into this year, a change in Washington, D.C. So we're looking for just kind of an adjustment year where there could be some volatility, and just being cautious on. I wouldn't be overweight Mag 7. I would be market weight. We're not saying to get rid of them at all. They're the tech revolution of America right now, and you don't want to bet against them. You just don't want to be overweight them while things are going on in the markets outside of their control.
That's perfect. Any last parting thoughts from either of you for our audience? Anything that they should keep in mind? Will, I love that you mentioned talking to your advisor. How are you communicating with clients and the advisors that you're working with about this topic?
Just piggybacking off of what you said, Tara, what Will said, it's a marathon, not a sprint. And I think, when in doubt, you got to zoom out on the chart, because a lot of, investors and a lot of people love to see like, oh, well, my stock fell 15% in 2 months. And then when you zoom out to 5 years, it's gone up 700%, so to speak. So it's good to keep in mind your entire financial picture and what your objectives are for your family and your household, and to talk to somebody that can kind of help walk you through kind of the choppiness and the volatility in the markets. That's why Will's point about reaching out to your financial advisor is probably the most important thing, because rather than just getting investment advice from them, it's somebody that you can bat ideas against and make sure you're on the right track for what you're trying to accomplish.
Right. It's the cost of volatility. To get compound returns over the long term, you've got to accept pullbacks in the market. And the role of a financial advisor is to help work through those corrections and not make the wrong decision. We've seen all the studies from Dalbar and others where if you get out at the wrong time, you could miss out on a potential up move from there. Markets are going to be volatile. There's 100 years of history of volatility, and it's about staying the course and ultimately getting in the right asset allocation, which is the mix of stocks and bonds and what type of stocks and what type of bonds that is the role that our financial advisors play that we love to help them out with. So that would be my parting thought there, Tara. Clayton.
Thank you. No, that's perfect. Clayton, I feel like you need to trademark "when in doubt, zoom out." That's perfect.
I stole that. I can't take credit for that. I don't want you
Oh
trying to go for the
man,
trademark.
shoot. It's a good one though. So there you have it. This has been once again really insightful, Clayton and Will. Thank you for your time. Whether the tech giants are headed for a shakeup or just a temporary pullback, one thing is certain: the market is never static. And while they may ebb and flow, having a strong investment strategy in place, guided by professionals like the Prime Capital Financial team, helps keep you ahead of the game, just like Clayton and Will mentioned. So don't forget to grab your free download that helps explain market volatility and how to plan for it. Clayton, Will, thanks for unpacking all of this with us today. And to our audience, stay informed, stay invested, and as always, we'll be here to help you navigate the twists and turns of the market along the way. Until next time.